Well, thank you, everyone, for joining today's Compliance Forum. Now, this morning, I want to talk about some of the key challenges we are now facing here in Hong Kong and also internationally. Hopefully, this will set the scene for what Julia and our guests will discuss on the first panel. From a global perspective, obviously, the COVID pandemic is the dominant theme. The crisis has put markets under unprecedented stress, and the global financial system has faced its most serious test since the crisis back in 2008. An extraordinary rapid collapse of both supply and demand in March led to an instant dash for cash and a resulting liquidity crunch in global financial markets. And of course, the COVID crisis is fundamentally different from the financial crisis 12 years ago, because this time, the shock originated from outside the financial system, a health crisis leading to an economic crisis and then to extreme distress in global financial markets. Nonetheless, the overriding objective shared by all financial regulators has been largely the same as it was 12 years ago. First, to intervene as necessary to ensure that a financial crisis doesn't make things even worse, and second, to maintain the functioning of fair and open markets to support real economies. Now, here in Hong Kong, the SFC responded on multiple levels as events unfolded over the year. We, of course, focused on potential vulnerabilities such as investment fund, liquidity stresses, and associated investor redemptions. We maintained a very close dialogue with firms and also with industry associations. And we announced temporary measures to ease the pressure on an industry which, until recently, was largely working remotely. We issued guidance together with the stock exchange to address market concerns about listed companies' earnings announcement and how and when shareholder meetings could be held. Now, with lockdowns and work-for-home arrangements in place, we also extended the implementation deadlines for some regulatory changes, and we made it clear that we would allow firms a degree of flexibility for staff who needed to work from overseas. We also allowed more flexibility in the fund authorization process. Now here, I just want to be clear that by being more flexible, we were very, very conscious not to lower our standards or compromise market integrity. Everything we've done is consistent with the overall global approach, which has been to adapt to the new environment without relaxing prudential and conduct standards. We kept a very close eye on operational risks arising from remote working, ensuring that the financial system remained resilient. So far, Hong Kong has, fortunately, fared relatively well in dealing with the pandemic, and our policy measures since March have succeeded in alleviating market strains. Globally, stress conditions have eased across markets and volatility has subsided. Now, of course, that was largely due to the massive central bank intervention in corporate credit markets, which basically came to a standstill in mid-March. Measures of market liquidity have, as a result, returned to pre-crisis levels, and we have seen increased investor risk appetite with a resurgence of corporate bond issues. But of course, the pandemic is not over. Now we have the prospect of long-term economic scarring, increased solvency concerns, ballooning government debt overseas, enlarged central bank balance sheets, also overseas, and a gathering second wave of COVID infections, particularly in the US and in Europe. But on the whole, our basic expectations of market participants remain unchanged. We've stepped up our supervision of funds and also of firms to address potential vulnerabilities, especially around new types of operational risk. And we, of course, make sure that our Hong Kong clearing houses manage their risks properly with appropriate margin policies. And as always, we will continue to pursue enforcement action to keep our markets clean. You may have seen that just last week, we levied our largest financial penalty ever in relation to the Malaysia 1MBD scandal. And then a South China Morning Post editorial yesterday commented on this, stating that, and I quote, the rule of law, clear enforcement of regulations, and strict penalties for miscreants are factors that set a healthy financial club, hub rather than club, hub, apart from becoming a nest of vipers. It concluded that to protect the local market's credibility, a watchdog such as the SFC must show its regulatory teeth and bite down hard on those who try to corrupt the system. Now, I think it's very hard for anyone to disagree with that. But of course, we face a second set of challenges, which are tied up with geopolitical tensions we are all now getting used to. These resonate especially in Hong Kong. Numerous concerns have been raised by market participants about past and potential sanctions from the US and potential implications of the new national security law on their activities. We've issued several public statements to make it clear that we are highly attuned to the possible implications of sanctions and also to the concerns that the new national security law naturally gave rise to. In fact, we made clear through a public statement in mid-July that we were not aware of any aspect of the new law which could change the rules and accepted practices governing trading in our markets or the way firms access and disseminate information under our regulatory regime. We also communicated what we expect of firms and market participants when they consider the implications of potential sanctions. That is, to manage their businesses and their legal risks appropriately and treat affected customers fairly. In doing so, the SFC has been very conscious of its role to assure the market that the essential attributes of Hong Kong's regulatory system will remain unchanged amid an admittedly febrile geopolitical environment. So in the past few months, we also made it clear that we will speak out in circumstances where matters of significant public interest call for a regulatory response from us. For example, after a rise in the share price of Next Digital, the owner of Apple Daily, following police action, we issued two statements which clarified our role as market regulator amidst a fair amount of media speculation, op-eds, and the like. These statements, like everything we do, are rooted in our core values of independence, integrity, and public accountability. We need to be clear-eyed about the challenges we face, and we also need to maintain our independence and impartiality at all times. Simply put, we're determined to ensure justified confidence in Hong Kong's markets, notwithstanding the geopolitical background, and I should say that we are not in the least concerned about irritating any particular constituency when doing our job as an independent regulator under the laws we administer. We will continue to regulate Hong Kong's markets in an impartial and transparent manner, just as we have always done, and you can depend on that. Now, against that background, I should mention requirements we set out last year in a circular on the use of external electronic data storage by firms. We made it a point that firms must ensure unrestricted access by us to regulatory records, even if the data is stored with an external provider outside of Hong Kong. Without this, our supervisory enforcement functions simply could not operate properly. So, for example, if regulatory records are required for legal proceedings initiated by us or by the Department of Justice, then it's crucial to ensure their authenticity and integrity and that we have prompt access to them. We heard rumors circulating that these requirements had something to do with the national security law. This is entirely untrue, but illustrates the difficult environment in which we now operate. First, the requirements were prompted in part by IOSCO's work on outsourcing and cloud computing. IOSCO was working on this in 2017, of course, well before the advent of the national security law. Second, our primary purpose was to enable firms to store their regulatory records using external providers for electronic data storage, including the cloud. Firms have a legitimate need to adopt new technology which increases efficiency and adds value. and there are clearly benefits in letting them do so. However, this has to be done in a way which complies with key regulatory objectives and requirements. Licensed firms need our written approval to use premises to keep regulatory records, and in the past, and for obvious reasons to do with jurisdictional reach, it has not been our practice to approve premises outside of Hong Kong for this purpose. So, when we made the decision to move ahead, we did so purely for regulatory reasons, and our overriding objective was to allow cloud storage whilst ensuring that it would in no way impede our ability to carry out our core regulatory functions. This last point is critical. The prospect of a case not being pursued just because the SFC could not obtain regulatory records located outside Hong Kong would be unacceptable. Or if we could not demonstrate to a court that records had been properly preserved from tampering, this would seriously compromise our effectiveness as a regulator. Since we first announced these requirements last year, we have heard concerns that there may still present some practical difficulties. Therefore, subject to certain criteria, we will adopt the industry suggestion that a firm's manager in charge or managers in charge be designated to bear primary responsibility for ensuring compliance in this area. And this would be in line with our broader objective to reinforce the accountability of senior management. And we will soon publish a set of FAQs to explain in more detail how this will work. Now I'll move from challenges to opportunities, which are also part of today's theme. The most obvious is to expand our role as the essential gateway bridging capital flows between the mainland and overseas. More than ever, Hong Kong's financial services industry is positioned to benefit from the further opening up of the mainland market and the development of the Greater Bay Area. Stock Connect has recorded spectacular growth since its launch, and southbound trading into Hong Kong accounts for an ever larger share of Hong Kong's stock market turnover. And despite global market volatility, Hong Kong has seen more secondary listings of US-listed mainland firms as US-China decoupling gathers pace. And the new listing regime for emerging and innovative companies has also diversified the issuer base. We're also driving the development of green and sustainable finance. This is now a key focus for us as we believe Hong Kong is well placed to become a regional leader. Just yesterday, we launched a public consultation on proposed requirements for fund managers to take climate risks into consideration and make climate disclosures in their investment and risk management processes. The challenges we have faced this year underscore the need for us to stay focused on the operational resilience of our firms and also market infrastructure. But we also need to keep ahead of global issues such as climate change, new technologies, and the continuing response to COVID. So, to wrap up, this year has been an extraordinarily difficult one, and in many ways uniquely difficult for Hong Kong, despite the subsidence of social unrest. But we have shown that we can work together to adapt and make the adjustment needed to meet unprecedented challenges. And through it all, I want to stress once again that the fundamentals have not changed in any way, and that our stance as the regulator of Hong Kong's capital markets remains the same. This is vital to maintain trust and confidence in our work, despite a fraught political environment. We fully understand that investor confidence in the regulatory system is absolutely essential for Hong Kong to thrive as an international financial center. Thank you, and enjoy the rest of this event.